Hey everyone, Coach Investor back to another video for today. So I started making maybe a bit more of this series because we get to look at different companies in one video, although it's not a deep dive, but it gives you, in my opinion, enough information for you to maybe start your own due diligence. So we're going to talk about 4 companies that are dividend paying companies, but also have growth ahead of them. Now, 4 companies, 2 of them I've talked I think once or twice on this channel. The 2 others I've never mentioned them before. Now it might be a bit longer than expected, so I'll make sure to have timestamps below. Now the first company is a company that deals with luxury. Maybe some of you already know what I'm talking about. If not, well, I'm talking about LVMH, Louis Vuitton Moet Hennessy, owned by Bernard Arnault, the wealthiest man on the planet. Well, at least his net worth is I don't know how much. He doesn't own all of this in his pocket, but he's worth X amount of money, and officially it's the number one. So this is the empire that he has built over the years. You've probably heard about the companies, right? Dior, Louis Vuitton, Moet Chandon, the champagne. Then more recently they acquired Tiffany & Co., Off-White. They deal with a lot, and it's not just watches or clothing. There is much more than that. And to be honest, I don't think they're stopping anytime soon with the acquisitions. So this is the current state of the company. This is on Coifin. There is a link down below if you want 10% off. Year to date, it returned 22.35%. If we look at valuation, forward PE of 24.4 times. Now, you might say, if you look at the graph here, actually, you might say, the stock has gone up tremendously in the last couple of years, and maybe growth isn't following that trend. Well, not really. And its dividend yield is 1.45%. It has an interim dividend and then a final dividend as well. It is in euros for those that didn't know. So what does the market expect here? Now, we don't really have that many numbers because, again, this is a European company, so we usually don't get as much information as we do with American ones. But fiscal year 2022 grew 17.3%, fiscal year 2023, 17%. This is for EPS, by the way. Fiscal year 2024 expected to grow 10.5%, and then 2025, 9%. When you look at sales, here we have fiscal year 2023, growth 11.24%, for 2024, 8.2%, and then 2025, 7.46%. Now with the revenues, we're at, last quarter, 21 billion. For next quarter, it expects to be basically flat. But when you look at those numbers here, right, like I said, it's not just fashion and watches, wine and spirits, perfume and cosmetics, selective retailing. So wine and spirits increased 3% year over year, fashion and leather goods 18%, perfumes and cosmetics 11%, watches and jewelry 11%, selective retailing 30% there, total 17% growth there overall. And this is despite them growing already quite a lot in the last couple of years, and seeing how the macro is today, I mean, these numbers are pretty strong. Now, of course, one explanation here is because they deal with luxury, and let's be honest, billionaires don't really feel the pain when inflation is super high or when interest rates are extremely high. And so a company like LVMH doesn't feel as much pain as you would expect it to. So that's company number 1. You have growth, you have a nice little dividend there as well. Now, company number 2 might not be one of your favorite companies around because they're dealing with things that are sometimes controversial, and that's BTI, British American Tobacco. Now, before I dive into that company, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not. We're on our way to reach 30,000 subscribers by the end of the year. So thank you very much for all the support. And if you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Now, let's look at an overview at this company. Now, forward PE 6.8 times, so not that expensive. Returns this year negative 15.6%. Dividend yield very, very high, over 8%. Stock returns from a year ago, negative 14%. Now, yes, overall, if you look at valuation, it is pretty cheap, especially if you look at the estimates for their growth when it comes to sales and EPS. So the estimates here for sales fiscal year 2023, growth is expected to be 7.3%, fiscal year 2024, 2.2%, then fiscal year 2025, 3.75. Now, if we look at EPS, fiscal year 2023, 8% growth there, fiscal year 2024, 5.58%, and then fiscal year 2025, 8.21%. So when it comes to earnings, the earnings growth, projected earnings growth from these estimates are much better than sales growth. And this might be a reason why the analyst price target, the average there sits at 40% higher than the price today. Now, this slide here was from their presentation for fiscal year 2022. So driving strong cash delivery, free cash flow pre-dividends, 2022, 8 billion pounds. Now, they say here that's around 30% of market cap return through dividends to shareholders, which is insane. 4 consecutive years of at least 100% operating cash flow conversion. Again, if you're looking at this from a pure dividend standpoint, your dividend payouts are very, very safe here. Now, of course, they're known for selling cigarettes, but if you haven't noticed, lately the switch have been made from the original cigarette to vapes or other electronic devices, which they obviously offer. So they have Views here, which is the e-cigarette. They have Glow, which is something that I found out more recently. It's not really burning nicotine, it's just heating it up. So it's, let's call it, less dangerous or less smelly or whatnot. And then you have Velo or Velo. These are basically nicotine pouches, which, by the way, are banned in Belgium. So this is obviously one of the risks that you have to take into consideration, that some of these products or potential other products, new products, might be banned in some countries. But as you can see here, growth has been quite nice in all 3 of those categories. And this was for fiscal year 2022. If we go and look at the first half of 2023, they give us a couple of numbers right here. So Views value share up 2.8 percentage points, reaching 38.8% in key vapor markets, driven by extended volume and value share US leadership. When it comes to Glow, they are a bit disappointed with the results there. So volume share down 1.1 percentage points to 18.2% in key markets. But they say here, as part of their enhanced innovation pipeline, they recently launched their Glow Hyper Air platform in 4 key European THP markets, with further rollouts planned for the second half of this year. And they probably assume that things will become better. Then as for Velo or Velo, remains modern oral volume share leader in 15 European markets, with Velo Mini and Velo Max continuing to demonstrate our commitment to innovation. Now they say here, Velo volume share of total oral was up 70 basis points, while volume share of modern oral was down 1.8 percentage points to 28.5% in key markets, mainly driven by the United States. Now, as for full year guidance, they say here they expect the global tobacco industry volume to be down approximately 3%. Now, for them, they expect 3 to 5 organic constant currency revenue growth, with performance expected to be second half weighted. But more importantly here, operating cash flow conversion in excess of 90%. So again, your dividend payouts pretty safe. Oh, and one last thing, apparently e-cigarette sales increased by nearly 50% between 2020 and 2022. Of course, I'm not really surprised, seeing those times were pandemic times and probably a lot of people were influenced by what they saw on their devices. Maybe they were stressed, depressed, and well, that's one way to get out of a pickle, I would say. Pretty sad, to be honest. Next up is another company offering maybe addicting products as well, but less harmful if we're being honest. And that's Starbucks. Yes, Starbucks. We all know what Starbucks stands for. So let's have a look at the current state of the company. Market cap of $110 billion, forward PE of 25.4%. So again, not really that cheap for such a company. Has a dividend yield of 2.21%. Total returns year to date, 2.21% there. Again, I am expecting this company to grow as a stock, as a company, and also grow its dividend over time. That's why it made the cut in this list. And here are the estimates for the next coming year. So for fiscal year 2023, sales growth of close to 12%. For 24, same thing there. And then for 25, again, 10.79%. So nice double-digit growth there for the next coming years, expected. When you look at EPS, same thing there. Actually, a bit better. So for fiscal year 2023, 15.79% growth, fiscal year 24, 19.63%, fiscal year 2025, 17.28%. And this is also why you see the average price target from analysts sitting approximately 20% higher than the price it is today. And yes, I know with Starbucks, you always have issues with unions. This is also something you have to take into consideration. And I would also like to add that probably in the future, a company like Starbucks will gain from automations, from robotics. It will make the company a bit leaner, doesn't have to hire, which is a bit sad, but doesn't have to hire humans to serve you. Oh, and they are operating, of course, in a market that continues to grow quite nicely. If you look at Rose Coffee 2023, $58 billion of a market. In 2028, close to $72 billion. And here's a quick overview from their last earnings report. So global net revenue increased 14% year over year to $8.7 billion. 21% of it was international, 6% channel development, and 73% North America. Non-GAAP EPS, as we've seen, profitability of the business becomes a bit better, 25% growth year over year to 74 cents. Non-global operating margin, 14.3%. That's also a 130 basis points increase year over year. They continue to increase their global store count by 6% in this case. Then if we look at comparable store growth, so globally 11%, North America 12%, internationally 7%, plus 3% in China. And yes, I do expect that now that China is reopening a bit more, they'll get a tailwind out of that country. And then for the licensing store, that increased 25% year over year. Last couple of things here with regards to Starbucks. So they reached 30.8 million 90-day active Starbucks Rewards members. And they say here that a record-breaking 57% of US company operating revenue is attributed to Starbucks Rewards members. And I think I said this 2 years ago or something like that, that Starbucks is a bit more like a bank rather than a coffee shop, because I do think that at the start of this year, they had around $1.6 billion of gift cards, worth of gift cards on their balance sheets, which is basically people giving their money to Starbucks, Starbucks holding that money, doesn't have to pay you any interest, nothing. You're giving your money away. What you're getting are some stars in the rewards program. But think about it. They had over $1.6 billion worth of your money on their balance that they can use, by the way. And obviously you will use it to buy coffee or food or whatnot. But think about it. It's pretty crazy. And last thing here, the board of directors declared a cash dividend of 53 cents per share payable on May 26, so that date has passed, to shareholders of record on May 12. The company had 52 consecutive quarters of dividend payouts with a CAGR greater than 20%. You see why this is making the list. And now last one, company number 4 is CVS Health, the American healthcare company, pharmacies. Yes, I know that in recent years, they've made a lot of acquisitions, expensive ones as well. It does take time. We've seen this with another company in the healthcare business as well, Teladoc, buying Livongo. Things haven't really gone as smoothly as expected. Same thing here with CVS. You can see it in the stock performance as well. You can see it on the balance sheets as well. That has increased over the last couple of years, and in a high interest environment, that isn't really so great. But overall, I do think that with a 3.5% dividend yield at a market cap of $88.68 billion, a forward PE of 8 times, still there is some growth ahead of this company. I do think that right now it might be very attractive to put this into your dividend portfolio. So the estimates for fiscal year 2023, when you talk about sales, 8.15% there. Fiscal year 2024 actually expected to decrease 2.36%. Then fiscal year 2025, 5.64% growth there. If we look at EPS, a decrease of 1% this year. Fiscal year 2024 increased 3.54%, and then fiscal year 2025, 10.84%. Their guidance, I think, for fiscal year 2025 is $10 per share or so. So this is a bit less than their own guidance. Now, CVS is in Time 100 most influential companies in 2023. If we hear what the chief medical officer has to say here, healthcare is broken. The company wants to put it back together. Over the past year, the drugstore chain led by CEO Karen Lynch has dropped close to $20 billion on acquisitions of Oak Street Health, a senior-focused primary care network, and Signify Health, a home healthcare provider. Between those deals, its 2018 acquisition of health insurance Aetna and the continued expansion of the Minute Clinic walking care brand, which now operates in more than 1,100 locations nationwide, CVS has cemented its role as a player in nearly every aspect of US healthcare. Again, it remains to be seen if they can execute correctly. Now, if we look at the last earnings report, we can see that total revenues increased to $85.3 billion. That's up 11% year over year. GAAP diluted EPS of $1.65 and adjusted EPS of $2.20, which is a bit less than last year. It generated cash flow from operations of $7.4 billion. So this is quite nice. And as you can see here, the revised GAAP diluted earnings per share guidance and adjusted EPS a bit down from previous numbers, and confirmed cash flow from operation guidance range of $12.5 to $13.5 billion. Now this is pretty important. They returned $779 million to shareholders through dividends and repurchased 22.8 million shares of common stock. And I expect this to continue, especially as their stock is down significantly. Maybe they should take the opportunity to buy even more shares. And so those are the 4 companies I wanted to cover in this video. Of course, there are many other companies that are paying a nice dividend and that are expected to grow in the years to come as well. If you own one of those companies, leave it down in the comments below and maybe they'll feature in the next video. So as always, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.